Hi there, accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 8, Receivables from Corporate Financial Accounting. So Chapter 8 essentially presents some of the accounting issues related to accounts receivable and notes receivable. Reason being, a major issue for the sales of merchandise or services on account is the potential that a customer might or might not pay. So there's a possibility that sometimes you have accounts receivable and it might not pay. So this chapter opens up with the common classifications of receivables, and we'll also take the time to make a clear distinction between accounts receivable versus a notes receivable. We'll also discuss when a company determines that receivables are uncollectable. We'll discuss the allowance and the direct write-off methods. In addition, we'll also discuss financial ratios that are related to receivables, such as the accounts receivable turnover and the number of days sales in receivables. So some of the chapter objectives for Chapter 8 includes describe the common classes of receivables, describe the accounting for uncollectible receivables, describe the direct write-off method of accounting for uncollectible receivables, describe the allowance method of accounting for uncollectible receivables, compare the direct write-off and allowance methods of accounting for uncollectible accounts, describe the accounting for notes receivable, describe the reporting of receivables on the balance sheet, and lastly, describe and illustrate the use of the accounts receivable turnover in days sales in receivables to evaluate a company's efficiency in collecting its receivables. So the receivables that result from sales on account are normally accounts receivable or notes receivable. So the term receivables includes all money claims against other entities, including people, companies, and other organizations. Receivables are usually a significant portion of a company's total current assets. So as we know, current assets are those that we expect to turn into cash within a year's time. So we are expecting to receive the cash owed from customers for the product that has been sold or the service that has been provided. So the most common transaction that creates a receivable is selling merchandise or providing services on account or on credit. The receivable is recorded as a debit to accounts receivable, and then we would credit our sales or our revenue account for the said amount. So such accounts receivable are normally collected within a short period. Normally it could be 30 or 60 days. And as mentioned, they are classified on a balance sheet as a current asset. Next, we have notes receivable. Notes receivable are amounts that customers owe for which there's a formal written instrument of credit that has been issued. So if notes receivable are expected to be collected within a year, then they are classified on the balance sheet as a current asset. However, there are some notes whereby it's used for credit periods of more than 60 days. So for example, an automobile dealer, they might require a down payment at the time of sale, and then they accept a note or a series of notes for the remainder. And in such cases, we have notes that have a monthly installment payment. Notes might also be used to settle a customer's accounts receivable. So notes and accounts receivable that result from sales transactions are sometimes called trade receivables. And as we go through this chapter, all notes and accounts receivable are from sales transactions. And then lastly, we have other receivables. And other receivables includes any interest receivable, taxes receivable, and receivables from officers and employees. And other receivables, they're normally reported separately on the balance sheet. So if they're expected to be collected in 1 year, it's classified as a current asset. And if it's expected to be collected beyond 1 year, then they are classified as non-current assets and reported under the caption investments, right? So just a key thing to keep in mind, is very important to be able to distinguish between a note receivable and an accounts receivable. So there's 3 key things to keep in mind. First, notes are typically for a longer period of time. 2, typically notes require a formal written agreement that states the due date as well as the interest rate. And lastly, Notes typically involve interest being paid. So it's very important to be able to distinguish between an accounts receivable and a notes receivable. Now we discuss uncollectibles. So for sale of merchandise or services on account on credit, one of the major issues is that sometimes customers will not pay. Some might deliberately choose not to pay. Some might fall on hard times and they can't pay. So that is, some accounts receivable will be considered uncollectible. So some retailers, often what they will do is they'll shift the responsibility to other companies. So if a business accepts only cash or credit cards, then obviously that company would have no uncollectible accounts. They essentially just shifted the risk to the credit card company. Some companies, they might also decide to sell their receivables. That's called factoring the receivable. And uncollectible receivables are called bad debt expense or doubtful accounts expense. Any unpaid accounts, they can be turned over to a collection agency. And there are two methods for accounting for worthless receivables. The first is the direct write-off method, and the second is the allowance method. So regardless of how careful a company is in granting credit, some credit sales will be uncollectible, as discussed. The operating expense recorded from uncollectible receivables is mentioned as bad debt expense, uncollectible accounts expense, or doubtful accounts expense. So some indications that an account may be uncollectible include the following. The receivable is past due. The customer does not respond to the company's attempts to collect. The customer files for bankruptcy. The customer closes his business. The company cannot locate the customer. So if a customer doesn't pay, a company may turn the account over to a collection agency. And after the collection agency attempts to collect the payment, any remaining balance in the account is considered worthless. So the two methods of accounting for uncollectible receivables are as follows. We have the direct write-off method and we have the allowance method. So it's very important to understand that the allowance method is the preferred and emphasized method. The direct write-off method can only be used if it's impossible to estimate a company's bad debt or the amount of the bad debt is immaterial. So just keep that in mind. Some examples of companies that use the direct write-off method are law firms or other businesses that typically don't provide services or products on account. So here we see the direct write-off method records bad debt expenses only when an account is determined to be worthless. The direct write-off method is often used by small companies and companies with few receivables. The allowance method records bad debt expenses by estimating uncollectible accounts at the end of the accounting period. Generally accepted accounting principles GAAP requires companies with a large amount of receivables to use the allowance method. So under the direct write-off method, bad debt expense is not recorded until the customer's account is determined to be worthless. So again, if a company decides to use a direct write-off method, they have to wait until they determine that the receivable, the account is going to be worthless, and then they write it off. And in such case, the bad debt expense is debited and the accounts receivable is credited to decrease the balance in accounts receivable. And let's just say if for some reason the account is later collected and payment is received, then we simply reverse the entry. The bad debt expense is credited and the receivable is debited to reinstate it. Then the cash is received, we debit the cash and credit the receivable. So again, this method is more so used by companies that have a small percentage of their assets in receivables. So here we see, assume that a $4,200 account receivable from D.L. Ross has been determined to be uncollectible. The entry to write off the account is as follows. We debit our bad debt expense account and we credit accounts receivable. And as we mentioned, sometimes the accounts receivable may be collected later. And in such case, we simply reverse the entry and then we record the cash that is being received and decrease the balance. So here we see it states, assume that D.L. Ross account of $4,200 written off on May 10th is later collected on November 21st. The reinstatement and receipt of cash is journalized. So now we essentially reverse the entry. We debit the accounts receivable and credit the bad debt expense account. And then now, once received the cash, we debit the cash account and we credit the accounts receivable. The direct write-off method is used by businesses that sell most of their goods or services for cash or through the acceptance of MasterCard or Visa, which are recorded as cash sales. So in such cases, receivables are a small part of the current asset and any bad debt expense is small. So as mentioned, some examples are businesses, a convenience store, and a small retail store. One of the challenges, however, with the direct write-off method is that it essentially violates the matching principle because the sales revenue and the expense related to an uncollectible account may be recognized in different accounting periods. So that's one of the challenges with the direct write-off method. It violates the matching principle. And next we have the allowance method. The allowance method estimates the uncollectible accounts receivable at the end of the accounting period. So when the allowance method is used, the business essentially estimates at the end of the period, and then there's an entry to bad debt expense. That's an adjusting entry recorded at the end of the period. And keep in mind, this entry is simply an estimate of the total uncollectible. Specific amounts can't be credited. So in such case, we see, assume that X-Tone Company began operations on August 1st, 2000, year one. As of the end of its accounting period on December 31st, X-Tone has an accounts receivable balance of $200,000. This balance includes some past due amounts. X-Tone estimates that $30,000 of the December 31st, 2000, year one accounts receivable will be uncollectible. On December 31st, year one, X-Tone doesn't know which customer accounts will be uncollectible. Thus, specific customer accounts cannot be decreased or credited. Instead, there's a contra asset account, allowance for doubtful accounts. It's credited for the estimated bad debt. So in this case, using a $30,000 estimate, the following adjusting entry is made on December 31st, 20, year one. So we debit our bad debt expense for the $30,000. And we credit our allowance for doubtful accounts for the $30,000. And what happens is that the balance in this allowance for doubtful accounts offsets the balance in our accounts receivable. So the preceding entry, as we just saw, affects the income statement as well as the balance sheet. So on the income statement, the $30,000 of bad debt expense will be matched against the related revenues for that period. And on the balance sheet, the value of the receivables is reduced to that amount that is expected to be collected or realized. So therefore, the amount of $170,000 is the net realizable value of receivables. So it's the $200,000 that was extended on credit minus the $30,000 that we do not expect to receive. So therefore, $170,000 represents the net realizable value. All right, and just keep in mind, both of the methods, they use estimates, right? Whether we are using the direct write-off method or the allowance method, both use an estimate. However, each method has a different focus and financial statement emphasis. So when a customer's account is identified as uncollectible, it's written off against the allowance account. And this essentially requires a company to remove the specific accounts receivable and equal amount from the allowance account. So in this example, on January 21st, year two, John Parker's account of $6,000 with X-Tone Company is written off as follows. So we would debit the allowance for doubtful accounts once we confirm that we are not receiving $6,000, and we would credit the accounts receivable to write it off. And at the end of the period, the allowance for doubtful accounts will normally have a balance. And again, this is because the allowance for doubtful accounts is based on an estimate. So as a result, the total write-offs to the allowance account during the period is very rare that is going to equal the balance of the account at the beginning of the period. The allowance account will have a credit balance at the end of the period if write-offs during the period are less than the beginning balance, and it will have a debit balance if the write-offs exceed the beginning balance. So here we essentially have a quick depiction. This is the adjusting entry to fill the bucket of the allowance for doubtful accounts. And then when we write off the accounts, we essentially empty the bucket, the estimate that was made. So it states, assume that during 2000 year 2, X-Tone Company writes off $26,750 of uncollectible accounts, including the $6,000 account of John Parker recorded on January 21st, year 2. Allowance for doubtful accounts will have a credit balance of $3,250. So it's the $30,000 that was estimated minus the $26,750. So it'll be computed as follows. We would debit the $30,000, or credit rather the $30,000 to allowance for doubtful accounts, and then all of the accounts that have been written off for a total of $26,750 leaves us with a balance of $3,250 in our allowance for doubtful accounts balance. So if X-Tone had written off $32,100 in accounts receivable during the second year, in this case, the allowance for doubtful accounts would have a debit balance of $2,100. We see here there's a credit balance of $30,000. Our total accounts written off was $32,100. So therefore, there's an unadjusted balance of $2,100. So the allowance account balances credit balance of $3,250 and debit balance of $2,100 in the preceding illustrations are before the end of period adjusting entry. So after the end of period adjusting entry is recorded, the allowance for doubtful accounts should always have a credit balance. So all of our accounts have a normal balance, and the normal balance for our contra asset account allowance for doubtful accounts should be a credit. So an account receivable that has been written off against the allowance account, it may be collected later, much like if we're using the direct write-off method. So once we determine that it can be collected, the account is reinstated by an entry that reverses the original write-off entry. And then from there, the cash received in payment is then recorded as a receipt on account. So here it states, assume that Nancy Smith's account of $5,000, which was written off on April 2nd, 2022, is collected later on June 10th. X-Tone Company journalizes the reinstatement and the collection as follows. So the first step is to debit the accounts receivable to reinstate the receivable, and we would credit the allowance for doubtful accounts. And then the next step is to debit our cash and to credit the accounts receivable. For estimated uncollectibles. So the allowance method requires an estimate of uncollectible accounts at the end of the period. And this estimate of current expected credit losses is normally based on past experience, industry averages, current economic conditions, and forecasts of the future. There are two methods that's used to estimate uncollectible accounts as follows. So we have the percent of sales method, and we have the analysis of receivables method. So as we look at the percent of sales method, this matches revenue and expenses, and it puts an emphasis on the income statement. And as we'll see later, under the analysis of receivable method, the estimate is based on the net realizable value of the receivables, and it emphasizes the balance sheet. So since accounts receivable are created by credit sales, uncollectible accounts can be estimated as a percentage of credit sales. So if the portion of credit sales to sales is relatively constant, the percent may be applied to total sales. So in this example, it states, assume the following data for X-Tone Company on December 31st, 2022, before any adjustments. So the balance of accounts receivable is $240,000. The balance of allowance for doubtful accounts is a credit of $3,250. There's total credit sales of $3 million, and there's bad debt as a percentage of credit sales of 3.4%. So in such case, the bad debt expense of $22,500 is estimated as follows. We calculate our credit sales multiplied by our bad debt expense as a percent of the credit sales. So in such case, our credit sales is $3 million. We multiply it by 3/4%, and that gives us $22,500. So our journal entry would be as follows. We would debit the bad debt expense, and we would credit our allowance for doubtful accounts. And then after we record the adjusting entry and it's posted to the ledger, the bad debt expense would have an adjusted balance of $22,500. And the allowance for doubtful accounts will have an adjusted balance of $25,750. The beginning balance of $3,250 plus the adjusting entry balance of $25,750. So under the percent of sales method, the amount of the adjusting entry is the amount estimated for bad debt expense. And this estimate is credited to whatever the unadjusted balance is for the allowance for doubtful accounts. Next, we have the analysis of receivables method. So the analysis of receivables method is based on the assumption that the longer an accounts receivable is outstanding, the less likely it is to be collected. So the analysis of the receivables method is applied as follows. So step 1 will determine the due date of each account receivable. Step 2 will consider the number of days each account is past due. And then this is the number of days between the due date and the account and the date of the analysis. Each account is then placed in an age class according to the days is past due. So some typical age classes includes the following in 30-day spans, right? So, or starting off in 30-day spans. So we start off with 1 to 30 days. Then we consider 31 to 60 days. Then we consider 61 to 90 days. And then from there it jumps. We look from 91 to 180 days, 181 to 365 days. And then we consider those that are past due for over a year. So the analysis of receivables method, we're continuing on. Step 4, the totals for each age class are determined. The total for each age class is multiplied by an estimated percentage of uncollectible accounts for that class. The estimated total of uncollectible accounts is determined as a sum of the uncollectible accounts for each age class. The preceding steps are essentially summarized in an aging schedule, and this overall process is called aging the receivables. So assume that X-Tone Company uses the analysis of receivables method instead of the percentage of sales method. So X-Tone prepared an aging schedule for its accounts receivable of $240,000 as of December 31st, 2000, year 2. So here we see we have Ashby & Co., BT Bar, Bruck Co., Saxton Woods Co. So we look at the balances that are due. And then from there, we consider the days past due. Is it 1 to 30, 31 to 60, 61 to 90, 91 to 180, 181 to 365, or over 365 days. So in such case, we look at the information that is presented, and then we consider the aging receivable schedule. And from there, we consider the percent that is going to be uncollectible. So the sum of the estimated uncollectible accounts for each age class, step 6, is the estimated uncollectible account on December 31st, 20, year 2. So this is the desired adjusted balance for allowance for doubtful accounts. And we compare the estimate with the unadjusted balance of the allowance accounts, and this determines the amount of the adjustment for our bad debt expense. So for X-Tone, the unadjusted balance of the allowance account has a credit balance of $3,250, and the amount to be added to this balance is $23,240. And we consider it as such. We determined what the ending balance should be, $26,490. We already have a credit balance of $3,250, so therefore we need to increase the allowance for doubtful accounts balance to ensure that the ending balance would be $26,490. So as we see it here, the original or the unadjusted balance was $3,250. We made our adjusting entry, and now our adjusted balance ties to $26,490. And as it states here, the second bullet point, now the net realizable value for the receivables is $213,510. Before, the amount that was extended on credit was $240,000, and we determined that $26,490 was uncollectible. So therefore, the net receivable is $213,510. So under the analysis of receivables method, the amount of the adjusting entry is the amount that will yield an adjusted balance for allowance for doubtful accounts equal to that estimated by the aging schedule. So in this case, we start to compare the estimation methods. So both the percent of sales and analysis of receivable methods, they estimate the uncollectible accounts. However, as mentioned earlier, each method has a slightly different focus in financial statement emphasis. So the percent of sales method places more emphasis on matching revenues and expenses, and thus it emphasizes the income statement. The bad debt expense is the focus of the estimation process under the percent of sales method. That is, we essentially record the adjusting entry based on the estimated bad debt expense for the period, and then we credit the allowance for doubtful accounts. However, under the analysis of the accounts receivable method, the allowance for doubtful accounts is the focus of the estimation process. So the analysis of receivable method, it places more emphasis on the net realizable value of the receivables, and thus the emphasis is the balance sheet. And that is that the amount of the adjusting entry is the amount that will yield an adjusted balance for the allowance for doubtful accounts that's equal to the estimated amount determined by the aging schedule. And then here we have a quick example. So again, under the percentage of sales method, we determine what the amount will be. We make an estimation and we debit the bad debt expense for the exact amount, and we credit the allowance for doubtful accounts for that exact amount. Versus the analysis of receivables method, we determine what the ending balance should be, and we basically plug in the number depending on what the unadjusted balance is in our allowance for doubtful accounts. So to compare, under the direct write-off method, there's no adjusting entry at the end of the period. And at the end of each period, the allowance method records an adjusting entry. So we'll take the time to, compare these two approaches. So it states the following transactions are taken from the records of Hobbs Company for the year ending December 31st, 2006. March 1st, they wrote off account for C. York, $3,650. April 12th, they received $2,250 as a partial payment on the $5,500 account of Carrie Bradshaw. They wrote off the remaining balances uncollectible. On June 22nd, they received the $3,650 from C. York, which had been written off on March 1st. They reinstated the account and recorded the cash receipt. On September 7th, they wrote off the following accounts as uncollectible: Jason Bigg, $1,100, Steve Brady, $2,200, Samantha Neely, $2,200, Stanford Noonan, $1,360, and Aiden Wyman, $990. And then on December 31st, Hobbs Company uses the percent of credit sales method of estimating uncollectible expenses based on past history and industry averages. 1.25% of credit sales are expected to be uncollectible. Hobbs recorded $3,400,000 of credit sales during the year. So here in this example, we have a key distinction between the direct write-off method and the allowance method. So on March 1st, under the direct write-off method, we will essentially debit the bad debt expense, credit accounts receivable. For the allowance method, we would debit allowance for doubtful accounts and credit the accounts receivable. So we see that there's some distinctions between the two. And then the next slide, we have a comparison that gives us a greater understanding. So here we see, under the direct write-off method, when a bad debt expense is recorded, under the direct write-off method, this is when the specific customer accounts are determined to be uncollectible. Under the allowance method, they use an estimate based on a percent of sales or an analysis of receivables. Under the direct write-off method, there is no allowance account. Under the allowance method, the allowance account is used, our allowance for doubtful accounts. And the primary users of the direct write-off method are small companies and companies with very few receivables. And the allowance method is used by large companies and those with a large amount of receivables. So that was essentially, taking a deep dive into accounts receivable. Now we start to consider notes receivables. So a note has advantages over an accounts receivable in that the holder has a stronger legal claim. So when a business has a note, the debtor usually signs the note and they agree to pay with interest the amount due on a specific date. So on the due date, the maker of the note must pay the maturity value to the payee. In a promissory note, it may be received by a business whenever a customer can't pay his or her account due. So essentially, the customer makes a promise to pay interest if they're giving a longer period of time to pay. So the note receivable can act as a form of replacing an accounts receivable. So a promissory note is a written promise to pay the face amount, usually with interest on demand or at a date in the future. So some characteristics of a promissory note include the following. The maker is the party making the promise to pay. The payee is the party to whom the note is payable. The face amount is the amount for which the note is written on its face. The issuance date is the date the note is issued. The due date or maturity date is the date the note is to be paid. The term of the note is the amount of time between the issuance and the due dates. The interest rate is the rate of interest that must be paid on the face amount for the term of the note. So here we have an example of a promissory note. We have the maker, H.B. Lane, the payee, Perland Company, the face amount, which is $2,000, the issuance date, which is March 16th, 20 year 8, the due date, which is June 14th, 20 year 8, the term, which is 90 days, and lastly, the interest rate, which is 10%. And then in Exhibit 7, this basically demonstrates how to determine the due date of the note. So from March 16th to the 31st, we see there's 15 days. April 1st to the 30th, there's 30 days. May 1st to the 31st is 31 days, and it's due on June 14th. So this is a term note of 90 days. So in order to determine the interest on the note receivable, it's computed as follows. It's the face amount multiplied by the interest rate multiplied by the term, which in this case is 90 days, divided by 360 days. So in such case, the note was for $2,000, the interest rate was 10%, the term was 90 days divided by 360, so therefore the interest is $50. So So the interest rate is stated on an annual yearly basis, while the term is expressed as days. So to simplify, 360 days per year will be used. In practice, companies such as banks and mortgage companies, they use the exact number of days in a year, which is 365 days. The maturity value is the amount that must be paid at the due date of the note, which is the sum of the face amount plus the interest. So when it comes to accounting for notes receivable, a promissory note may be received by a company from a customer to replace an account receivable. So in such case, the promissory note is recorded as a note receivable. Assume that a company accepts a 30-day 12% note that's dated November 21st in settlement of the account for W.A. Byrne Company, a Bun Company, which is past due and has a balance of $6,000. The company journalizes the receipt of the note as follows. So we debit notes receivable and we credit accounts receivable. So we are basically shifting it. It's no longer treated as an accounts receivable. It's now treated as a note receivable. So at the due date, the company journalizes the receipt of $6,060, the face amount plus the interest. They would debit cash for the $6,060, the full amount received. They would credit the notes receivable for the face amount and credit interest revenue for the additional $60 earned. So if the maker of a note fails to pay the note on a due date, the note is a dishonored note receivable. And a company that holds the dishonored note transfers the face amount of the note plus any interest due back to an accounts receivable account. So here we say, assume that the $6,000 30-day 12% note received from W.A. Bun Co. and recorded on December 31st is dishonored. The company holding the note, as mentioned, they transfer it back to accounts receivable. So we would debit accounts receivable for the $6,060, credit the notes receivable for $6,000, and credit interest revenue for the $60. And now the company that receives the note, they would have to record an adjusting entry for any accrued entry at the end of the period. So assume that Crawford Company issues a $4,000 90-day 12% note dated December 1st, 20-year 3 to settle its accounts receivable. If the accounting period ends on December 31st, 20-year 3, then the company receiving the note would journalize the following entries. December 1st, debit to notes receivable, credit to accounts receivable, and on December 31st, they would debit interest receivable that they're expecting to receive and credit the interest revenue for the accrued interest on this note. So the receipt of the maturity value of the note on its date, which is March 1st, 20-year 4, would show as follows. We would debit the cash for $4,120. We would credit the note receivable for the face amount. And then from there, we would account for the interest receivable as well as the interest revenue that has been earned. So the interest revenue account, it would then be closed at the end of each accounting period. And the amount of interest revenue, it's normally reported in the other revenue and expense section of the income statement. So as we're dealing with receivables, we, as mentioned, need to report them on the financial statements, in this case, the balance sheet. So all receivables that are expected to be realized in cash within a year, they're reported in the current assets section of the balance sheet. And current assets are normally reported in the order of their liquidity. So liquidity simply means how soon an asset can be turned into cash. So we always start off with cash because cash is already cash and cash equivalents. And a company may choose to subtract the allowance for doubtful accounts from accounts receivable on the balance sheet to report the net realizable value of their receivables. So some other disclosures, such as any unusual credit risks within the receivables, they're reported in the financial statement notes. So for example, if the majority of the receivables are due from one customer or due from customers located in one area of the country or one industry, then these facts are disclosed because obviously it has an impact on the decisions that the financial statement users will make. And then we have the analysis for decision making. So we know that this chapter uses two financial measures that are helpful in evaluating the efficiency with a business that collects its receivables. So the first, which we'll review now, is the accounts receivable turnover. And it essentially measures how frequently during the year the accounts receivables are being converted to cash. It's computed as accounts receivable turnover. The computation is sales divided by average accounts receivable. So in this case, sales is our numerator and our average accounts receivable is our denominator. So the average accounts receivable can be determined by adding the beginning and ending accounts receivable balances and then dividing them by 2. So in this example, we consider Under Amour. We have the sales for year 1 and year 2, and we have the beginning and ending balances for our accounts receivable for years 1 and years 2. So the accounts receivable turnover for years 1 and year 2 is computed as follows. We divide, or we add rather, the beginning of the year accounts receivable and the ending of the year divided by 2, and then we divide that into our sales. So for year 1, it is 8.2, and in year 2, it is 7.7. So in such case, the key thing to keep in mind is that we see that the accounts receivable turnover declined in year 2. We went from 8.2 to 7.7. So this essentially suggests that Under Amour is allowing customers to take longer to pay their accounts. And is this a good thing or a bad thing? Ultimately, I think about it like this. If the customer is going to pay if you give them a longer period of time, then hey, why not give them the extra time versus not getting the money at all? Next, we have the days in sales receivables, and this is an estimate of the length of time that the accounts receivable has been outstanding. So with credit terms of net 30, the days in sales and receivables should be about 30 days, and it's computed as follows. So in our numerator, it's the average accounts receivable divided by the average daily sales in our denominator. So the average daily sales are determined by dividing sales by 365 days. So in this case, we're using information from the previous example, and we would divide our sales by 365 for both years 1 and years 2. And then from there, we divide the amount of our average accounts receivable, which was calculated earlier, by our average daily sales. So in year 1, it was 44.5 days, and in year 2, 47.3 days. So as we can see in this example, the days in sales increased from year 1 to year 2. So this confirms that Under Amour's efficiency in collecting accounts receivable declined from year 1 to year 2. So they lengthened the credit terms, or selling in markets where longer credit terms are standard could cause the decline. So the efficiency in collecting accounts receivable has declined whenever the accounts receivable turnover decreases or the days sales and receivables increases. So the efficiency in collecting accounts receivable, it can be compared across companies or even similar industries. So here we see in this example, Under Amour versus Columbia Sportswear. So we look at the accounts receivable turnover for, Under Amour versus Columbia Sportswear in year 1. Under Amour is 8.2 and Columbia is 6.5. In year 2, Under Amour is 7.7 and Columbia is 6.9. Versus the days in sales receivable in year 1 for Under Amour is 44.5 days, and for Columbia it's 56.2 days. And in year 2 for Under Amour, it's 47.3 days and 52.9 days. All right. So again, it's important to be able to understand this with our accounts receivable turnover. It's the relationship between sales and accounts receivable, dividing the sales by the average accounts receivable. And this measures how frequently during the year the accounts receivable are being converted to cash. And then lastly, the number of days sales and receivables. This depicts the relationship between sales and accounts receivable, computed by dividing the average accounts receivable by the average daily sales. So this brings us to our last slide. And now that we've come to the end of the PowerPoint lecture for Chapter 8, Receivables, you should have learned to describe the common classes of receivables, describe the accounting for uncollectible receivables, describe the write-off method of accounting for uncollectible receivables, describe the allowance method of accounting for uncollectible receivables, compare the direct write-off method and the allowance method of accounting for uncollectible accounts, describe the accounting for notes receivable, describe the reporting of receivables on a balance sheet, and lastly, describe and illustrate the use of the accounts receivable turnover and days sales in receivables to evaluate a company's efficiency in collecting its receivables.